Welcome to the deep dive. Imagine, if you will, walking into this high-stakes Wall Street boardroom.
Right.
But instead of a dozen guys in expensive suits, aggressively pitching stock strategies to each other, the room is completely empty.
Just dead quiet.
Yeah, exactly. There is just a server humming quietly in the corner. And that server isn't just crunching the numbers someone handed it. It is entirely on its own, inventing investment strategies that yield a massive 59.53% annualized return.
It is a staggering image, honestly, and an even more staggering statistic, especially when you look at the risk-adjusted performance. The research we are looking at today shows this autonomous system achieving a Sharpe ratio of 3.11.
Wow.
And crucially, that is completely out of sample, meaning it was validated against unseen market data, not just, back-tested theory.
Okay, wait, before we go further, you just mentioned a 3.11 Sharpe ratio. For anyone listening who isn't a quantitative analyst, that's basically the ultimate sleep-at-night metric, right?
Yeah, pretty much.
It measures how much return you are actually getting for the risk you're taking.
Yeah. Exactly right. In the quantitative finance world, a Sharpe ratio of 1.0 is generally considered excellent. It means your returns are solidly beating the risk you are taking on. To see a metric reliably above 3.0 on unseen data is, well, it's almost unheard of.
Right.
It's just a level of performance that fundamentally challenges how we think about market efficiency altogether.
And again, the most incredible part isn't just that return. It is who, or rather, what actually found it.
Exactly.
Today, we are exploring a research paper titled Beyond Prompting, an autonomous framework for systematic factor investing via Agentic AI. Our mission for you today is to explore how artificial intelligence is evolving. We are moving from AI being this passive tool that just answers our prompts into an autonomous, self-directed researcher that can navigate complex financial markets entirely on its own.
Right, it's a huge shift.
Okay, let's unpack this because we are talking about a massive leap in technology here.
We really are. To understand why this is so revolutionary, we need to set the broader context of what is happening in computer science right now. We are witnessing a profound paradigm shift from traditional AI to what is known as agentic AI.
Agentic AI, got it.
Right. So traditional AI systems are essentially passive analytical engines. They are phenomenal at recognizing patterns within structured data sets, but their utility is strictly banded by explicit rules. They basically just wait for us to prompt them.
They just sit there until a human types something into the box.
Precisely. Agentic AI, on the other hand, represents a leap toward autonomous, goal-driven systems. And agentic AI actually perceives its environment, in this case, the chaotic dynamics of the stock market.
Right.
It engages in multi-step reasoning, it executes actions, and it continuously learns from the outcomes of its own decisions, all with virtually zero human input.
Which is wild. So if human bias is the problem, but we still need the logic, how do we get the AI to check its own homework? I mean, why do we need a server doing this instead of a human researcher in the first place?
Well, this brings us to a concept in the paper called the factor zoo.
The factor zoo. I love that term.
Yes, the factor zoo is a great term. Historically, finding systematic return predictors, the underlying factors that drive stock prices up or down relied entirely on human intuition.
Right.
A researcher would have a hypothesis, test it against historical data, and see if it held up. But as market data just exploded over the last 2 decades, researchers found themselves drowning in an infinite sea of variables.
Just too much noise.
Exactly. This gave rise to the factor zoo, a massive, tangled proliferation of variables that supposedly predict returns.
I mean, think about it like cooking. Traditional AI is like having a world-class, super-fast sous chef. This chef is incredibly efficient, but entirely lacks imagination.
Oh, that's a good way to put it.
Right, like they can finally chop 1,000 onions in a single second, which is amazing, but they still need you to stand there and hand them every single step of the recipe. If you don't give them a recipe, they just stand there holding a knife.
That is a very accurate way to look at it. Traditional machine learning requires human quantitative researchers to manually engineer the features, define the rules, and continuously prompt the model. The human is the bottleneck here.
Oh, wait, let me play devil's advocate here for a second. Isn't finding hidden patterns exactly what traditional machine learning is already famously good at?
Right.
If you feed an AI 1 billion data points about the stock market, won't it just find the winning recipe on its own? Why is a human prompt such a bad thing here?
This raises an important question. You would think letting the machine hunt for patterns is a good thing, right?
Yeah, exactly.
But in finance, letting a machine just search endlessly leads to something researchers call p-hacking. It is essentially the dark side of data science.
Dark side. Okay.
Yeah, machine learning is exceptionally good at finding patterns. The danger is that if you let a machine search through millions of data points long enough, it will inevitably find a pattern that looks incredibly profitable in a historical backtest, purely by chance.
Like finding out that butter production in Bangladesh perfectly correlates with the S&P 500 for a 10-year period. It is just math, but it means absolutely nothing.
Exactly. That is a spurious correlation. It is just historical noise. When human researchers use traditional AI, they often fall into this trap. They keep tweaking their prompts, trying different combinations, until they find a backtest that looks fantastic.
And then they publish it or trade it.
Right. But because there is no underlying economic reason for the pattern, like the butter in Bangladesh, it completely falls apart when they try to trade it in the real world.
Yeah.
A mathematical pattern without a solid economic rationale is usually just a trap.
So we have this tension. Human prompting is a massive bottleneck because we can't test ideas fast enough, but human bias also causes us to fall into these data mining traps because we really, really want to find a winning strategy.
Precisely.
How do you build a robot that doesn't just do raw math, but actually thinks about the underlying finance?
The logical solution that researchers came up with is to completely remove the human prompt, but enforce incredibly strict scientific discipline on the AI. They built what they call the agentic loop.
The agentic loop.
Right. It is a 5-step closed-loop workflow that is entirely autonomous. The steps are hypothesis generation, data alignment, backtesting, gatekeeping, and memory update.
Walk us through how that actually looks in practice, because hypothesis generation sounds very abstract.
Sure. What makes this so powerful is that the agent operates on the REACT framework, which stands for reasoning and action. Before the AI is allowed to write a single line of code, it utilizes chain of thought prompting. It uses a predefined grammar of market primitives.
Wait, market primitives being the basic building blocks like stock price, trading volume, volatility.
Exactly. So imagine the AI looking at trading volume and price momentum. Instead of just crunching the numbers, it literally writes out a logical sentence. Yeah. It might say, if trading volume spikes significantly over 5 days, but the stock price drops, this indicates aggressive panic selling by retail investors. Therefore, the stock is likely oversold and will rebound in the short term.
Wow.
It has to explicitly state why a certain combination logically predicts a stock's return before it even touches the math.
That is wild. It has to explain its logic out loud, essentially acting out an internal monologue.
Yes, and only once it formulates that economic hypothesis does it translate it into a mathematical expression. Then it aligns the historical data and runs a strict statistical backtest.
Here's where it gets really interesting to me. The next step is gatekeeping. The AI basically acts as its own notoriously strict peer reviewer.
Yes, it's brief.
The paper notes it uses a t-statistic hurdle of 3.0 for its out-of-sample testing. Let's translate that for the listener. What does a 3.0 t-statistic actually mean?
Right, so a t-statistic is simply a measure of statistical significance. In most academic research, a t-statistic of 2.0 is considered the standard benchmark to say, hey, this result probably isn't just luck. By setting the hurdle at 3.0, the AI is enforcing a much stricter standard. If the out-of-sample data doesn't clear that massive hurdle, the AI actively rejects its own idea. It has a promotion gate, and only the absolute best ideas get through.
And if it fails, it moves to the memory update phase, right? It logs what failed and why, so it explores new ideas instead of repeating past mistakes.
Exactly. It learns.
But I have to push back here. If this AI is searching a near-infinite space of math formulas at light speed, how do we know it's not just the infinite monkey theorem? You know, millions of monkeys betsing on typewriters until one accidentally writes Shakespeare. Isn't it just running millions of combinations until it accidentally finds a fake pattern that passes even that strict 3.0 test?
What's fascinating here is that the framework actively prevents it through something called economic regularization.
Economic regularization.
Right. Because the AI is forced to generate that logical financial explanation jointly with a mathematical formula, it inherently filters out purely combinatorial anomalies. A human quant doesn't just look for high returns, they look for a mechanism. The AI does the same.
Interesting.
By binding the math to human interpretable economic theory, the search space is regularized. It cannot just rely on raw, lucky math.
Okay, so we have this brilliant, deeply disciplined scientific loop. But a brilliant loop is useless if it doesn't discover anything of value. Did it actually find anything good? Let's look at the actual signals it unearthed.
It did. The paper details 12 specific autonomous factors that the AI discovered and promoted to its final library. And these individual factors are remarkably strong on their own.
Give us an example.
For instance, there's factor 6, which the AI defined as a combination of price relative to trend and realized volatility. There's also factor 10, which follows a logic based on risk-adjusted price levels.
And the performance on those was huge, right?
Massive. The researchers constructed long-short portfolios based on these signals over an out-of-sample period from January 2021 to December 2024. Both factor 6 and factor 10 generated high-low spread returns of over 35%.
Wait, over 35% on a single factor?
Yes, and crucially, they showed strict monotonic rank ordering.
Okay, define monotonic rank ordering for us, because that sounds intense.
It's actually simple. Imagine a staircase going perfectly up or perfectly down without any dips or roller coaster hills in the middle. Monotonic rank ordering means that the higher the AI scored a stock based on its factor, the better that stock performed in reality.
Okay.
And the lower it scored it, the worse it performed. It's a perfectly linear relationship, which proves the signal is incredibly robust and not just capturing random outliers.
But in the real world, a hedge fund doesn't just bet on one single signal, right? They combine them. And the researchers tested 2 different ways of combining these 12 factors together.
They did. They tested a basic linear model, which essentially just adds the signals together, and a highly complex tree-based machine learning model called LightGBM.
LightGBM.
Yeah, the LightGBM model is designed to capture non-linear interactions. Stock returns are incredibly complex, and sometimes a factor only matters when it interacts with a specific market condition like high volatility. LightGBM captures those complex interactions.
So combining them made it better.
Much better. Integrating these heterogeneous signals proved to improve stability immensely. The LightGBM composite strategy produced a much smoother drawdown profile. When the market experienced severe stress, this combined portfolio recovered significantly faster than the simpler models.
So what does this all mean? We need a reality check here. I am looking at this 59.53% return, and it sounds like monopoly money. In the paper, the turnover diagnostics show that this strategy replaces about 109% of its portfolio every single day.
Yes, that's high.
Let's do the mental math. If I am turning over my entire portfolio every single day, I am paying broker fees, I am crossing the bid-ask spread. Doesn't all that theoretical profit just evaporate in real-world commissions?
If we connect this to the bigger picture, it is the most common pitfall in quantitative research. A strategy looks amazing on paper, but transaction costs eat it alive. However, the researchers specifically addressed this real-world viability by running a rigorous transaction cost analysis. They assumed a highly realistic 3 basis points per trade.
Wait, so 3 basis points? That's a 0.03% cost on every single trade.
Correct. And even after subtracting these heavy market frictions, the net cumulative return chart shows a remarkably steady upward trajectory. The excess return generated by the strategy is thick enough to survive the trading costs.
Wait, slow down. 109% daily turnover surviving fees is insane. Are you saying the AI actually looked at its own trading fees and realized, oh, I'm trading too much, I'm losing money to commissions, I need to adjust?
Yes. Because the agentic loop includes that memory update phase we talked about, the AI actually learned to penalize high turnover signals that yielded thin profit margins. It dynamically adapted its search policy.
That is amazing.
It essentially realized that a signal was too expensive to trade, so it prioritized finding signals that offered enough of a return cushion to withstand market impact. It proved that it fundamentally understands the realities of market microstructure, not just theoretical data relationships on a spreadsheet.
Okay, that is mind-blowing. It survived transaction costs. But we still need definitive proof that the agentic reasoning process, the whole verbalizing the economics part, is the true secret sauce here.
Right.
Because a skeptic could just look at this and say, well, of course it performed well. You used a state-of-the-art LightGBM math model at the very end to aggregate the data. How do we know the AI's reasoning is what actually matters?
This is where the methodology truly shines. The researchers anticipated that exact skepticism, so they set up a direct control test, a showdown, if you will. They compared factors mined by the autonomous agentic AI versus factors mined by traditional AI frameworks.
So it's agentic AI versus traditional AI.
Exactly, and they evaluated both sets using both the simple linear aggregator and the complex LightGBM aggregator. So when they actually put these head-to-head, the results were incredibly revealing. The agentic linear combination, where they used the intelligent agentic factors, but aggregated them with a very basic, simple linear math model, achieved an annualized return of 58.80%.
Wow. 58.80% on the simple math. And how did the traditional AI do when it was given the super complex aggregator?
The traditional LGBM combination, using traditional AI factors processed through the highly complex, state-of-the-art light GBM model, only hit 50.84%,
I mean, think about it like cooking again. If you have an incredible self-correcting farmer who carefully sources your raw ingredients,
which represents our agentic AI.
exactly, and then you just cook those amazing ingredients in a basic cheap microwave. The linear model, it will actually yield a better meal than using a state-of-the-art $1 million smart oven.
The light GBM model.
Right. Using that smart oven to cook low-quality, mass-produced ingredients from a traditional AI pipeline. The ingredients matter more than the oven. The source of the ideas matters more than the math used to crunch them.
That is a perfect analogy. And the underlying truth it reveals aligns with a core belief in data science. Knowledge is most valuable when it's deeply understood, not just mathematically processed. The traditional machine learning pipeline is static. It finds patterns in historical data, but when the real-world market changes, those patterns break down.
And we actually saw this in the data, right? In mid-2022.
We did. During the high market volatility and regime changes of mid-2022, the traditional AI models showed drastically slower growth. They couldn't cope with the new environment.
Wow.
But the agentic models maintained a steady upward trend. Because the agentic AI has the ability to reason, reflect on its policy, and adapt its memory to changing market environments, it is fundamentally superior to static data pipelines. It isn't just fitting a curve to past data, it is conducting an ongoing, disciplined research process that actively manages shifting market dynamics.
It is truly remarkable. So let's synthesize all of this for you listening. Whether you are prepping for a major finance meeting or you are just insanely curious about cutting-edge tech, the real takeaway from this deep dive isn't just a fancy stock dip.
Absolutely not.
It is a very clear glimpse into the near future. We are watching AI shift right before our eyes. It is moving from being a passive assistant that sits around waiting for our commands into an autonomous colleague, a colleague that can conduct disciplined end-to-end research, catch its own mistakes, understand real-world constraints like trading fees, and adapt to entirely new environments.
It really forces us to reconsider the role of the human in complex analytical fields. The value is no longer in manually turning the crank on the data machine or writing the prompts. The value moves to defining the high-level goals and building the governance structures, the guardrails, that allow these agentic systems to explore safely and efficiently. The human becomes the architect of the research laboratory, rather than the technician running the daily experiments.
Which leaves us with a final, lingering question to mull over. If this single agentic AI is so incredibly good at independently finding hidden market inefficiencies and exploiting them to the tune of nearly 60% annualized returns, what happens to the stock market in 5 years when every major institution deploys their own competing armies of agentic AIs? Will these incredibly smart machines simply cancel each other's alphas out entirely, creating a perfectly efficient, completely flat market? Or will they interact with each other to create entirely new, hyper-complex AI-driven market anomalies that human beings can't even begin to comprehend? It's something to think about next time you see a jaggy white line on a chart and assume you know exactly what it means. Turns out, the machine might be reasoning through something you can't even see.